leverage and capital structure. So the first thing on the agenda is anyone? Leverage. Yes, thank you.
Okay, so first let us define what is leverage. So leverage is the use of fixed cost assets to magnify return to owners. So we have three types of leverage, which is operating leverage, financial leverage, and total leverage.
What is operating leverage?
Okay, good question. Operating leverage is how we use fixed operating costs to magnify returns. So the formula for operating leverage is percentage of change in earning before interest and tax divided by percentage of change in sales. Let's say, for example, the change in EBIT is 100% increase and the change in sales is 50% increase. So when we calculate the DON is 2. And the second way to calculate it is by sales level, which is shown by this formula: quantity times price less variable cost divided by quantity times price minus variable cost minus fixed cost. So let's say, for example, we produce 100,000 units and the price is 35 ringgit and the variable cost is 21 ringgit and the fixed cost is 1,050,000. So when we calculate, the DON is 4.0. That's all for operating leverage.
How about financial leverage? What is financial leverage?
Financial leverage is the use of fixed financial costs to magnify return to owners. It is calculated by degree of financial leverage, which is percentage of change in EPS divided by percentage of change in EBIT. So let's say the EPS increased by 100% and the EBIT increased by 40%. So the DFN for that year is 2.5. Can someone show me how to another way to calculate DFN?
I can. So another way of computing financial leverage is if you have information on EBIT and preferred dividend plus tax, then you can use this formula. EBIT divided by EBIT minus interest minus preferred dividend times 1 over 1 minus tax. So, for example, if the question asks you to compute the financial leverage at base level EBIT of 120,000 and the information given is this one, interest expense with the 25,000, preferred dividend 3,000, and you have common shares outstanding 200,000, which is in this problem it is not related. So the way to compute it is that you take the EBIT, which is 120,000, and then you divide by EBIT 120,000, and then minus by interest, which is 25,000 interest expense, and then minus by 300,000, which is our preferred dividend, divide by 1 minus tax, which is in this problem tax is 40%. Okay. So after computing all this, you get financial leverage of 1.33 for a base level of EBIT of 120,000.
How do you compound the leverage that describe the risk of the company as a whole?
So to calculate the leverage of the company as a whole, which is you will need to combine both leverage, operating leverage and financial leverage, it will come up with total leverage. So the formula to calculate total leverage is percentage change in EPS divided by percentage change in sales. And then another formula that you can use if you have enough information, like if you have information of degree of operating leverage and financial leverage straight away, you can just multiply both of the leverage to get the total leverage.
I want to ask, as you said before, what kind of risk that associate with leverage?
Okay, as leverage reflects risk, operating leverage reflects business risk, and financial leverage reflects financial risk. Business risk is risk of not being able to cover your operating costs. Okay, so whenever you want to make a decision regarding your business, like you want to introduce a new product, like or do a partnership with another company, you would have to compute the leverage first before coming up with a decision, so that you know to what extent the risk of going with the decision would affect your business. Would you be able to pay your operating costs or not? Okay. And then the second risk, which is financial risk, this is the risk that financial leverage reflects. Financial risk is the risk of that is associated with your debtors. For example, the preferred shareholders and your debtors and your creditors. So financial risk is basically a concern to shareholders because shareholders is the owner of the company, and then this risk is also related to the company's capital structure. For example, like if the capital structure of the company is 60% debt, then it is most likely that financial risk of the company is also higher.
So now we are going to talk about capital structure. So what is capital structure? Capital structure is the mixture of debt, preferred stock, and common equity. So now, what is the optimal capital structure? Optimal capital structure is used to maximize the share price of the firm. This is the formula for optimal capital structure. This is just a general formula. The formula is earnings before interest and tax times with 1 minus tax, that is the tax rate, and then divided by the weighted average cost of capital. So we are going to talk about break-even analysis. So what is break-even analysis? Break-even analysis is used to determine the level of operations that is necessary to cover up all the operating costs. So the break-even point is the level of sales that is needed to cover all the operating costs. So the formula is the quantity means the quantity equals fixed cost divided by the price minus variable cost. So let's see. For example, you have a fixed cost of 2,500, and then the price per unit is 10 ringgit, and the variable cost is 5 ringgit. So apply the formula, and we get 2,500 divided by 10 minus 5. So we get 500 units.
What does 500 units mean?
Oh, 500 units is the quantity needed to cover up all the operating costs. So yeah, at 500 units, the profit equals to 0. So does anyone knows how the other way to find the optimal capital structure?
Yes, I know. Okay, basically, every EPS approach is select capital structure that maximize EPS over expected range of EBIT. Okay, we look at this table. Okay, at 0% debt, we can optimize our capital structure.
What are the shortcomings of the EPS approach?
Okay, because we use EPS, so we just based on earning. So basically, earning is one of the determinant of maximize shareholder wealth. Okay, second, when we use this approach, we cannot determine, we cannot consider the risk. Okay. Besides, we also can optimize our capital structure by balancing our equity and debt financing.
What are the benefits of debt financing?
Okay. Basically, benefit of debt financing, we can reduce our tax disadvantage of debt financing. First, when we have more debt, so it may lead to bankruptcy. Second, agency cost imposed by lender, which is lender may charge higher interest to us. Asymmetry information is manager and shareholder not have same information.
Okay, next is capital structure theory. Modigliani and Millers, or known as M&M, assuming that perfect market is the capital structure that a firm choose do not affect its value. So the assumption that they come up with the perfect market is it must not have tax and no chance of bankruptcy, perfectly efficient market and symmetry information. Symmetry information means that the investor and the manager have some information about the investment prospect. Okay, that's all.